Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 240th VideoCast podcast for the week ending May 23rd, 2024. A lot of great stuff to cover today. Just want to kick it off. On Wednesday, I will be on Cavuto, Coast to Coast with Neil Cavuto between 12 and 1 p.m. That'll be my first time on with Neil Cavuto on Fox Business, so check that out. On Monday night, I will be on the BBC World Business Report at 5:30 p.m., so check that out. A couple family updates, and we'll get right down to it. This was Mimi and Annabelle at MIT over the weekend for a swim meet, and Mimi and Annabelle swam all new personal bests at the MIT meet this weekend. 11-year-old Mimi won the 11 to 12 200 IM, 100 back, and 200 free. 9-year-old Annabelle won the 10 and under 50 free, 100 free, 50 back, 100 back, and 50 fly. So really proud of these two. All the hard work is paying off. Congratulations. That's me with my friend Ken. Want to thank him and Grant Thornton. If you have any auditing needs, do reach out. I will put you in direct touch with Ken. They're the best. That is the barn in the background. We got to play Westchester Country Club this week. That's my first time ever, and that was an unbelievable treat. This was at our club over the weekend. We both have my friend Joe and I both have our Portugal hats on because we're both oddly the only 6'5" males in America that both have 50% Portuguese descent. We played together in a pairs tournament this weekend. We made it to the second round, not much further than that, but we had a blast and a super guy. Here's that famous barn at Westchester Country Club, and that's their clubhouse, which is unbelievable. I guess they have like condos and hotels. It looks like the Scientology building, but it's quite a beautiful and historic club. All right, moving into the business of the week here. Want to go through a couple short-term indicators because I'm sure a number of you are like, what's going on in the markets? I can tell you this, when you see these advanced decline indicators get this oversold, negative 2,500, 2,400 on the NASDAQ and negative 2,000 on the NYSE, we're probably due for a short-term bounce. That doesn't mean that we won't have further weakness, but I think we're probably going to see a bounce, if not into the weekend when we get back. I think there's a lot of taking off risk before people went out to the Hamptons is really what it comes down to. The National Association of Active Investment Managers, that was up to 94.45% today. So they are a little bit over their skis, and I think it was kind of an anticlimactic event today with NVIDIA having good earnings, and everyone thought that was going to fuel the next leg, and it was kind of a sell the news. But bullish percentage is elevated, as you can see here, 47% bullish, 27% bearish. So this makes sense to get a little bit of check back, and we'll go through this stuff one by one. We've got our RBC Robert Slumer charts from my friends over there. You know who you are. You can see here they're looking at the decelerating momentum. You know, this is a breakout. Their next target is 5,600. I don't know if we get that this year or we get it next year is more likely, but you can see the long-term uptrend here. And then, again, this breakout after a cup and handle. So the measured move from whatever it was, 3,400 to 4,800. So that was 800, 1,600 plus 4,800, that takes you to 6,400 over time. We're not going to get there anytime soon, but it goes to show you these Fibonacci extensions they have at 5,400 on the daily. I can 100% see that this year, and maybe sooner than everyone thinks. We did cover a few weeks ago the seasonality of summer rallies in the election years. I think we are going to see that even if we get a couple bumps here in the next few days. Even equal weight is starting to participate, and most importantly is the Russell, We have another data point I believe we're going to be covering on the Russell that I think you'll find extremely interesting from Jim Paulson. Those of you who remember him from the Luthold group, he has a blog now on Substack, and I've always been a huge fan of his. I think he does great work, so we'll get you that information here. But the Russell is where you can play the catch up and I think get some outsized performance into year end. Bumping up against a little resistance here, like a lot of these things are. Emerging markets just breaking out. This is finally starting to happen, ladies and gentlemen. This is another place to get catch up, small caps and emerging markets, and you can see it here clearly. Tokyo, again, you know our view on Japan. Let everyone else chase, have fun. And then Hang Seng, we had this monstrous move in the last few months, and now we're running up against this resistance at this, whatever it's called, 61.8% Fibonacci level. So maybe we have to consolidate for a few weeks before blasting back out, and that's normal in the Justin Mammoth cycle, which we've covered multiple times on this, moving from anxiety to disbelief and then back into returning confidence, and it's going through the process perfectly. The 10-year yield, this is the most important chart in the world right now. It looks like a head and shoulders top, working back off, ticked up a little bit higher today. The key fear, what you're finding, ladies and gentlemen, what's going on? Any company with debt is selling down. Why? Because you had the Fed speakers out being a little hawkish again, and you had the Fed minutes, which were from weeks ago, when all the inflation prints had been hot, and we've since had more rational inflation prints since, spooking people. And you saw the odds of a cut come down from 58 to 51%. So people get worried for any companies that have debt, their ability to refinance, et cetera. Ladies and gentlemen, I can tell you one thing. We are seeing signs of slowing. The Fed will be cutting once or twice this year. And once that is playing out, all of these companies are going to rally like nobody's business. And we've seen spurts of that last quarter of last year, in recent weeks before this recent choppiness. All you need to do is watch the 10-year yield. This is going to work back down below 4%. If you remember when it was up at 475 or something again, everyone was saying it's going back over 5, and I said it's going to go below 4 before it goes above 5. And we stand by that. It's rolling over, and it's going to work down even if you get some head fakes along the way. The head fakes are on purpose, ladies and gentlemen. That's how it works. So here, this thing will head fake back up to here probably. Everyone will start talking 5 again before it reverts back down to 3, 8 and change. And everyone will say, what happened? The dollar, same story, rolling back over. Remember here, everyone said the dollar's going back to new highs. We said, no, this is a counter trend rally. Sure enough, now it's hit this trend line. It's going to test this, fake everyone out, maybe shoot up a little bit before it reverts back to 99 and then lower. This trend line here. So look, there's some support here. So it could bounce around here for a little while on the dollar index before breaking the trend, but we think the trend is down. The Canadian dollars, my friends that sent me the jersey, Alex and co, man, you guys are going to be smiling so wide you could eat a banana sideways as this Canadian dollar just works higher and higher and higher. So before long, we're going to have these Canadians coming in from Alberta with their cowboy hats buying up Rockefeller Center like the Japanese in the late 80s when everyone said the world was going to be the land of the rising sun. It turns out the sun set pretty quickly on that thesis, and now it's Canada's turn. Famous words no one's ever said. But I think we're going to see some instances of that. Look, they've got the best actors and the best hockey players. Why not strengthening currency? Okay. Energy ticking back up again. Natural gas has obviously had a great run. We're playing that through what? Comstock Resources investing what? Pari Passu with Jerry Jones, the owner of the Cowboys, who made his fortune in oil and gas over decades. If I want any partner, it's him. Largest assets in Haynesville, near the Gulf, exporting LNG is the name of the game. Copper remains strong, which is a proxy for China activity, which we saw industrial production up 6.7%. And and still everyone's bearish, which is great. We want a rally that climbs the wall of worry, because that means it's nowhere near anywhere close to being even mid-cycle. It's just beginning. First half of the first inning. What else did I want to cover here? Alibaba. So, it's had such a huge move. Ladies and gentlemen, all it's done is put in this right shoulder, inverse head and shoulder, measured move for an inverse head and shoulder, 58 to 119. So that's 60 points. Plus that takes you up to 180. You even have this 50% whatever Fibonacci Picasso level or whatever they want to call it. And I think that's conservative. And the key is, how long does it take? Today we're going to cover the convertible offer, why they're doing it, and but just to put things in perspective, those of you who's like, oh my God, it shot up from 68 to 90 and now it's back to 80. It's going back to 60. No, it's not. It's knocking out all the people who bought it at 88 who didn't want it down at 68. It's just the way the game is played, and it will work higher. Why? Because it's one of the cheapest stocks in the world, but AI plays for sure in the world, and it's just getting started. PayPal, here we go, baby. This one's breaking the down trend line and just getting started. By the way, I'm so excited about this week creating the opportunity that it's creating to put fresh money to work. VF Corp, we were able to pick up a little more today before it almost, by the way, how hysterical is that? That in such a weak tape with the Dow down 600, VF Corp was down double digits after hours last night. It almost closed positive today. I think it was down 2 or 3%, which was less than most stocks in the S&P 500. So there you go. And we're going to cover plenty on VF Corp today. Slumer did some really good charts this week. Generac, awesome. Head and shoulders, again, just getting up to the neckline, and the measured move takes us well over 200. That's just getting started. And look, guys, you were on this call. We were pounding the table well under $100 on TV when it was in the 80s. So, double here almost, and like literally hasn't even begun. Very excited about that one. And I think that's all I wanted to cover today on those. Moving right along, let's go through a bunch of companies that we've talked about on this podcast so we can just put it in perspective, the short-term choppiness that we're seeing. Advanced Auto Parts, we're going to get their earnings at the end of the month. This is a normal check back. You see it every time during recoveries. This thing is perfectly on track. We're excited about that one. Remember, betting on the jockey, the guy ran HD Supply, $7 billion business for Home Depot very successfully. Amazon looks like it wants to break out. That's pretty exciting. Remember, we were buying in the hole in October of 2022 and March of 2023. Go back and look at the tape. Boeing, those of you who missed Boeing, you got another chance today because they said we're not going to generate cash flow this year. No, you know what, Sherlock? Like, we could do the math. Like, you can't screw up anymore, other than the fact that you still have a 10-year backlog and there's no one else for people to buy from. It's good to be the king. What can I say? So if you missed that opportunity to put money to work, we're excited about. Brace for turbulence. And I say that actually, let me take that back, because like they had a headline about that, but someone actually had a bad outcome. So I don't want to. Moving right along. Alibaba, okay, we covered that. It's just working its way higher. That's what it always does. And then you'll get a check back right before you get the parabolic move back up. No one believes it, but you'll see. And then all the ones that don't believe it, when it's at 180, you're going to want it until the cows come home. And we'll be smiling so wide we could eat bananas sideways. Baxter, okay, we're going to cover a lot on that. I love the way this bottom formation is coming in, scaring the hell out of everyone. This is going to be a great play over the next couple of years. And we think multi-bagger, certainly a double, and then, exceeding our IRR hurdles that we set for ourselves in terms of what we want capital to do over a reasonable amount of time, and this falls within that category. We like that setup. Citi still knocking on the door here. M&A, first cut, M&A, debt refinancing, equity offerings, IPOs are going to come back roaring. We think that's another quarter out. If they cut in September, the back half of the year is going to be a beast for the big banks. I think in the meantime, you probably see a little give back on the big banks. CCI, Crown Castle, love it. Love that you have another opportunity to bite at the apple here. This is all about rates. And as the 10-year moves below 4, this is going to work its way back up to new highs over the next couple of years. Cooper Standard, we covered in depth in the last couple of weeks. Love it here. Comstock has made a move. You know, we were talking about it. It got down to $7. We were talking about 7 and 8. It got up to 11. It's 1080. Not even started. This thing is going to work higher over the next 3 to 5 years, just like Range Resources did, which, by the way, broke out to new highs. Or multi-year highs. I think it got over 36 today or yesterday before the market got weak. Let's see. Yeah, this thing's breaking out. Unbelievable. Base is down at 4 and change. Disney, awesome opportunity around $100. I'd love it to come in a little bit lower, but again, there's so much awesome, amazing stuff to do here. Emerging markets we covered. Estee Lauder, we haven't spent a lot of time. We've mentioned that a couple of times. Generac, we just covered, you know, we looked at that. It's like, wow, huge move from 80 to 150. Step back, zoom out, as we always say, hasn't even begun. Google breaking out to all-time highs. Awesome. Again, that was in October 2022, March 2023. Goose, the goose is loose. $14.02 in a week tape today. Unbelievable. Okay, we were pounding the table at $11. It dropped down to $9.80. Of course, it always goes against us before it goes for us. It has to be that way. It's mandated by the gods. Say anything that Tom buys, it has to go down a little bit in the short term before we give him the multi-bagger. It's just part of his DNA. And here we go, up to $14 in a week tape. This thing is just beginning. Hormel, we've talked about that once or twice. This thing is working its way back to new highs over the next couple of years. Intel, we love it here below 30. Remember, we bought at 25. It went up to 48. We sold. It went beyond that, sold 2/3. It went beyond that to 50. We kept a third, free money on the house, rolled back down to 30. We're now building that position back up. We love that here. And then KRE just getting going. That's the small cap banks. 3M, couldn't touch this thing with a 10-foot pole. Now it's up from 70. Remember, this is spin-off adjusted. So you also have the free Solventum on top of the 3M, which is now up from 70 to 100 and moving higher over time. PayPal hasn't even started, just broke the downtrend. And the reason I'm talking about charts is not because that factors at all into our entry points. We always give the fundamental case, but we like when these confirmatory things start to bring in the herds that look at these things thinking that they have some edge that no one else is looking at, which everyone just piles on with the algos, which we love. So, and they'll help us on the way out as well. C, which is kind of a Sing version of Alibaba in a lesser extent. That thing's taken off. You couldn't give it away earlier this year. And then Semtech, we've never really discussed on this call, but Stanley Black & Decker, love this one. Building that base. It's going to work higher over time. We spent some time on that in recent weeks. VF Corp, we're going all day long today on that. Just hang tight. XBI, which is the biotech. There was another deal announced we posted it. I think Biogen did a $1.5 billion deal yesterday. So the game is on. Rates come down a little bit. You're going to see this work back up to 150 plus. I'm going to make so much money with that. Excited about it. And Stiefel, thanks to my buddies over there. I give this sell side some cred. They got some cojones to come out after that earnings report with a buy rating, price target 19. That's obviously a very conservative price target. But they say the sum of the parts view of the portfolio of assets thesis still holds. We await greater clarity on decisions to divest brands, improve visibility on debt reduction. We view the sale of an asset and resulting debt reduction central to the upside case. We've been saying that since day one. We are encouraged by leadership developments while estimates... Okay, so look, they got a $19 target. In our view, the VF Corp game starts at $19. Yeah, it's a double or whatever it is, 80% from here. This thing is going to have so much upside over the next 3 to 5 years. All that needs to happen is the same thing that happened with Cooper Standard when we were pounding the table at $5.10, which is, or $5.50, whatever it was, which is that they need a catalyst with their debt. Now, the good news is they've got over $2 billion of available liquidity. They generated $800 million of free cash flow last year, which is the name of the game when it comes to turnarounds. But what is going to take place is it could be tomorrow, it could be next month, it could be 5 months from now. You're going to wake up and they've done over $1 billion of asset sales and they pay down a ton of debt. Their interest expense goes down and the stock doubles literally in a matter of days. And you're going to say, how did I miss that? It's Supreme, which is rumored to be for sale by Goldman Sachs, is shopping it, is growing. Okay, it's growing materially, and that alone they can get a ton of money. Never mind the PAX business, and never mind other assets that they could potentially sell while Bracken turns around Vans, which, by the way, is a lot of these brands are doing quite well in China, again, confirming what we saw from Canada Goose, confirming what we're seeing from Alibaba, and our favorite friend, Pinduoduo, who I continue to say revenues are either unsustainable or unreliable. Time will tell, but you can go chase that shiny object and have at it. We are going to pass-a-roo. Fed officials saw longer wait for rate cuts after inflation setbacks. So this is the problem this week, is people looking in the rearview mirror at the Fed minutes and extrapolating things that don't matter because we've got better inflation numbers in the interim and some slowing in the economy in the interim. This is the chart I was referencing thanks to Seth Golden, sent over Paulson's chart, which you can get on paulsonperspectives.substack.com. This guy is really good. I'd suggest you follow him. And what this is large cap equal weighted to market weighted stock market relative total return. And this is from 1926 to 2024. And basically what he's saying is, here's what happens to small caps after the large cap weighted indices outperform so dramatically to the equal weighted. And you can see over the next 2 years, annualized total return for small caps, 107%, 32%, 35%, 31%, 31%, negative 8%. That was February of 2000, so that's not really helpful. 2008 was 25%, and the most recent was 33.9%. So what does this say in English? It says small caps are going up, because there's been such an extreme outperformance of large caps relative to equal weight. And prospectively, that favors small caps, and that's how we're positioned, and that's what we like. Intel set to launch AI-centric processors meeting Microsoft standards by Q3 2024. The AI computers is going to be the next theme. Intel owns PCs. This will be no different. And, as we've continued to say, the legacy business, the data center chips and the PC chips, the boring stuff, is worth $45 to $50 a share, which is why we took 2/3 off at 48. But the free option on the AI story could be $100 plus, and that's to be determined. But either way, the margin of safety at $29, $30, in our view, humble opinion, could go to 25 before it goes to 50. I won't lose sleep because I know what I own. Is well worth it. And this is just more evidence of that. Again, Japan's 10-year yield tops 1% for the first time in 11 years. Ladies and gentlemen, this is the name of the game. Japan has been the backstop of liquidity throughout COVID. While the West was tightening, Japan was accommodative, buying our bonds, buying our equities. Now the West is moving into accommodative stance. Started with the Fed back in the market, $35 billion a month buying bonds. How quickly people forget that liquidity is real. And the Bank of Japan is moving into restrictive. What does that mean? Yen will go up over time. Dollar will go down over time. Dollar down helps everything. Biotech, emerging markets, China, small caps, regional banks, everything. Crown Castle, everything we've been talking about, ladies and gentlemen. This is the genesis of that game, and it's playing out according to plan. Washington's pivot on bank rules could free up tens of billions. That's why we like banks. Citi, we own Citi, we own BAC. We think those are actually going to see some chop before the end of the year when they do the cut and then the investment banking business. But regionals also, and this will be great if they do that. That means that the banks will finally get out of their long-term funk and really start to print money again, which is good news. Baba pumps $230 million into Lazada. That's the group, the international, growing like almost triple digits. They're putting more money in there. Smart move. So why did Alibaba take a little bit of weakness? Alibaba is considering a convertible bond sale. This was a rumor from Bloomberg, following JD.com doing the same thing. They're looking to raise $4.5 billion from a convertible bond following a $1.7 billion offering by Chinese rival JD.com. So why the hell would they do this? Because when you think of converts, it's dilutive. Why? Because they get debt, they get cash for very low money below market. So if the market is 7%, they would be getting this convert at 25 basis points, which is basically free money in an expensive money environment, in exchange for the right to convert that at some strike well higher than the current present price. Now, buy low, sell high. I know outside this podcast, that's a very unpopular philosophy. Everyone says they do it. Very few people actually do. More are into chasing shiny objects, and eventually they get, upside down. But the point is, if they can raise $5 billion, and buy in stock at $80 or $85 or $90, and then they get the equivalent amount converting at $140, they're buying low and selling high, and they may not actually wind up doing the conversion if they have the right to buy in the convert. So why are they doing this when they've got some $70, $80 billion of cash? The issue, and part of the reason that their buyback has not been more aggressive, is they generate all of their cash in China with Taobao and Tmall, and there are restrictions on their ability to get that cash out of China in order to buy stock in the open market in Hong Kong and in the US. So by raising the money abroad, they can use the abroad-based cash to buy in more stock. And everyone's misinterpreting it that it's, number one, dilutive, and number two, that they need cash. All you need to do is actually look at a balance sheet to realize that's not the case. So if they can do these converts at 25 bips to 75 bips, I hope they do a lot more than 5 billion. They should do 30 billion and have a call feature where they can then buy it in as they get more and more cash out of China, and then they get the dual primary listing in Hong Kong where they can raise more equity if they choose to that way down the road. So a lot of things going on here, but a negative interpretation is not one. 99 problems, but dilution ain't one. Alibaba shares rise as investors grow confident in long-term outlook. That's from the Wall Street Journal. Canada Goose jumps 16% after the company reports growth surge in China. We covered that last week. Tepper scoops up Baba. He called it the cheapest company in the world. Welcome aboard. Choo-choo on the Baba train. China attempts to end property crisis with broad rescue package. China's e-commerce market still has ample room for growth despite slowdown in retail sales. JP Morgan analyst says slowdown in retail sales. Well, one thing that they missed about retail sales, which I forgot to post, but I'm going to pull it up here. Well, I guess the big thing was, I reposted from Brendan Ahern, e-commerce sales from, well, okay, I'm not going to find it. E-commerce sales from January through April of this year in China were up 11.1%. This is re-accelerating growth, and Baba is the toll taker, and they've made the investments now to keep the competition at bay, and that's why you saw a resurgence in growth in this quarter's earnings. China's capital markets set for renewed growth for many years to come after Beijing's rescue actions. Alibaba sees steady revenue increase, gross merchandise volume, and order numbers on Taobao and Tmall return to double-digit growth track. China's industrial output up 6.7% in April. China's stock rally far from over as Beijing doles out stimulus, and China's property stimulus bazooka fuels instant rebound as sentiment as inquiries, home sales in Shanghai and Beijing jump. The game is back on, ladies and gentlemen. China's 618 shopping festival. Alibaba touts early sales after withholding the data last year, a sign of a brighter outlook. So in China, when the numbers are bad, they just say we're not going to report them anymore. And when the numbers are good, they're always happy to share. No different from the government. And it's nice to see that they're sharing this year. Here is the data point I was looking at. China's online retail sales jump 11.5% in January through April period. China's improving market breadth is good news for stock bulls. So you can see these periods where more and more stocks start to participate, precede massive parabolic moves in Chinese equities. This time will be no different. Alibaba, again, all of this is opinion, not advice. Go to hedgefundtips.com, scroll to the top, click on terms, and we will also play our lovely disclaimer at the end of the podcast. If you are listening on a podcast and not viewing on YouTube, go to youtube.com, hedge fund tips, and you'll be able to read the disclaimer there as well. Alibaba bets on AI to fuel cloud growth as it expands globally to catch up with US tech giants. This is huge. That's where all the investment came up, and we discussed it as it related to free cash flow last week. And now to the article of the week, my favorite part, the boring business, stock market, and sentiment results. So, while most investors and managers like to talk about their winners, in hindsight, we prefer to spend the bulk of our time on ideas that have not yet left the station or are stalling before takeoff. In other words, things we can make money with prospectively versus ideas we have already made big money from. That brings us to this week's first focus of Baxter International. You can't get more boring than Baxter. We love boring. So here's a chart of Baxter. Baxter International, through its subsidiaries, develops and provides a portfolio of healthcare products worldwide. The company operates in 4 segments: medical products, therapies, healthcare systems, and technologies, pharmacies, pharmaceuticals, and kidney care. Baxter Incorporated Baxter International was incorporated in 1931, the depths of the Great Depression, and they're here 90 years later to tell the story. It's headquartered in Deerfield, Illinois, in this beautiful corporate campus, which they are, by the way, selling to as part of their transformation and recovery program, as they do every cycle when they get fat and then they've got to get lean, and that's exactly what they're doing. So this is their GLP-1, getting rid of these outdated buildings. So now, while the company was started in the Great Depression, 1931, it is evident that it is not only a durable company, seen many cycles, but one that rarely affords the opportunity to buy the stock at a greater than 50% discount from its previous highs. In the last 40 plus years, there have only been 4 other such opportunities to buy it at 50% plus discount. In each case, the company eventually worked back up to new highs, yielding a multi-bagger return for investors with enough staying, i.e. stomach power, to sit tight and trust the company to work through yet another natural cycle. So you can see here, 1, 2, 3, 4. Okay, you can see for all of our CTAs or whatever that designation is, oversold, oversold, oversold on RSI, on slow stochastics and all that. Forget about all that stuff. All you need to look at is free cash flow generation, their ability to recover, the balance sheet, and you don't need any of these squiggly lines. But I show you to point out that it's an extreme that is rarely seen 4 other times in 40 years, and this time will be no different. You'll be choppy at the bottom for a while, take a year or two, and then all of a sudden it just all recovers overnight, and then it gets up here and everyone gets excited and we say, sold to you. Now, this business has been a serial compounder for decades, but in recent years, bit off a bit more than it could chew with the acquisition of Hillrom in 2021. It's taken a few years to digest, but now the company seems to be inflecting and turning the corner. So you can see here, sales per share have grown from $18.20 a share to $30 a share over the last 10 years. Dividend has more than doubled from 49 cents per share to $1.18 per share. Cash flow has moved up from $2.76 a share to $5.25 per share. Operating margins are holding in. They kind of troughed last year. They're now reaccelerating. And return on capital has always been kind of healthy double digits. It's high single digits the last few years since Hillrom. This looks like it'll reaccelerate back to the mean of about 12%. And return on equity is still healthy double digits. And that's the key. Now, one of the things that will help it is taking the capital down and paying down that debt when they sell. They were originally going to spin the kidney business. Now it looks like they're going to sell it to private equity. That'll give them a lump of cash, pay down debt, and that's going to increase the returns prospectively. It currently trades at 10.7 times forward earnings and offers a 3.3% dividend and growing dividend yield while you wait for capital appreciation. So you could find yourself, and this is how Buffett made so much money in Coca-Cola. When you buy a company that has a history of increasing their dividend, and you can buy it in these rare instances down 50% plus, you not only wind up with a potential double plus over the next few years, but your dividend might go from a 3.1% dividend yield to a 5% dividend yield or more on your basis. And it could be even more if they're also doing buybacks. So you could wind up with a stock that's double plus collecting 6% a year in perpetuity if you want to hold it for the long term and pay no capital gains. That's pretty darn attractive. Well, and that's what a lot of people don't pay attention to, the compound increases in dividends with a dividend grower when you're able to lock in a super high yield due to a temporary dislocation in price. So while the company has identified a solution to fix the low multiple, 10.7 times versus its historic 18 times multiple, and get the stock re-rated, i.e. spin or sell the slowest growing division, the kidney care, the stock currently has an overhang due to the fact that management stated that the kidney care business may be sold instead of spun out to shareholders, but either way, it will be completed in the second half of 2024. So we'll have some finality in a matter of months, not years. Markets don't like uncertainty. With the recent sale of the Biopharma business, they were able to pay down $3 billion of debt. They got $4 billion out of that sale. And here's what we've heard from management in this quarter's earnings release and presentation. First, they exceeded previous guidance both on the top and bottom line. They raised their guidance, they released new products, and they disclosed they were in discussions for an outright sale of the kidney business to private equity. Whether sold or spun, it'll be completed by the second half. EPS, they expect full year diluted between 288 and 298. This is a $35 stock, or less $34 stock. That is a rare opportunity and growing. Okay, sales, double-digit growth in pharmaceuticals. Okay, so we got through that. They got 5 new approvals, et cetera, et cetera. So Morningstar did a pretty good note on it after earnings, talking about $67 fair value estimate. I think if you're talking about a 12-month price target, I think that's reasonable. That's a 12 to 18 month. That's almost a double. I think if you look 3 years out, I think that's very, very conservative. And that's that. So some other highlights. If you look at these numbers, gross margin increased by 230 basis points. Operating margin increased by 150 basis points. And if you adjust for one time, one's up less, one's up more, and then diluted EPS up 33% on an adjusted basis. And they explain the adjustments, which are legit one-time situations. Their sales were up 3%, their operating margin up 180 basis points, and their EPS up 33%. Adjusted gross margin, we covered all that. Now, $3 billion of cash and cash equivalents on hand, with access to $2.7 billion of combined credit facilities as of March 31st, 2024. What are the key things to look for when doing a turnaround? Number one is solvency risk. That's what we always look for. What's your max downside? And number two is free cash flow and liquidity. And this has both in spades, so they have more than enough runway for their turnaround. You can see each segment by segment, the growth, which was pretty stellar across all different segments. And finally, guidance they took up, etc. So let's just go through the earnings call, some of the key points, and then we'll move on to VF Corp. The big story here was the US FDA clearance of their new leading edge Novum IQ volume infusion pump and Dose IQ safety software. So this was also an overhang on the stock. Now they have the most competitive in the market, and he references that some of their biggest wins are actually taking back share from clients who had a one-up before this approval. They're now regaining their leading position by taking that back now that they finally got approval. That is a big deal, and we're early days. This only started to impact in the last few weeks of Q1 on a run rate, and they don't even have it baked into their guidance increase, which is going to be proved to be very conservative. They're also executing on all the things that tripped them up about their supply chain, and experience this year significant improvements. Okay. Acute therapies, adjusted growth margin, 170. Okay, margins up. We talked about that. SG&A moderating. Net interest expense decreased by $39 million due to the pay down of they pay down $3 billion of debt. So they decrease of $39 million in the quarter, which is big. We're going to do another sale of the kidney business, which will be another big pay down. And this thing's just going to be a cash machine. All right, 4% exit rate. Baxter. Okay, so the analyst Vijay Kumar asked him, can Baxter get back to like a 4% top line growth? Like when does Hillrom normalize? And Joe says, committing to a 4%, around 4% exit rate for the year. And that's because they had a postponement of orders, some operational issues that got pushed into the back half. So that's really good news to have the business growing at that fast of a clip. with taking huge costs out, with interest expense decreasing, and everything else. So this is a big deal. Next was, so Novum is going to be, will have an impact on the company in the second half of the year when we start shipping. So they haven't even started shipping since the approval. That's going to be a big deal. That was a big overhang for a number of quarters. Our objective right now is competitive conversions, and I think we can make a significant impact there in 2024 and even more so in 2025. Now an analyst says, well, what's the tall pole of the tent? Where is the most significant single growth driver? And he says, our pump conversion rates will be what's going to make that business grow, is going to be the competitive conversions to our biggest competitor, because we have a product that is new and it fulfills significant market needs. We also have in our HST portfolio more than 7 significant launches in 2025. All right, moving on to VF Corp. VF Corp reported earnings after the bell last night. At first blush, they were not good. Our thesis in VF Corp is predicated on Bracken Darrell's ability to turn around the company. We are betting on the jockey. It's what he has a history of doing from his days at Logitech. When he became CEO at Logitech in January of 2013, the stock had been declining for several years to the tune of 82% down. The blue vertical line below is when he took over. So it dropped 82% from its peak several years before. Okay. And within 7.5 years, the stock was a 27 bagger. 1 million invested became $27 million. Of note, for almost the first year, he was CEO of Logitech and turning around the company from an 82% decline that preceded him. The stock continued to go lower before it finally turned. So this is when he came in. The stock continued to drift lower for the next almost year before it inflected and never looked back and was a 27 bagger. The same thing is happening with the turnaround at VF Corp. He has made a lot of changes at the company in 10 months, but the stock is drifting down before it turns around, and he shocks everyone just like he did at Logitech. I have no idea. It was a commodity camera producer, and he was able to turn it into a 27 bagger. So if he can turn a commodity camera producer that has no massive brand equity like Vans or Timberland or North Face or I don't know if they're keeping Supreme or not, Dickies, etc., then he can definitely turn these around into multi-baggers for sure, especially from such a low basis. Oddly enough, he took the helm in July 2023, blue vertical line, after VF Corp was down 82%. Like, how ironic is that? He came into Logitech after it was down 82% after a few years, and he came into VF Corp after it was down 82%. Maybe that's his magic number, joining companies when they're down 82%. As well, is drifted lower in his early months at the helm, just like Logitech before the turn. At the end of the day, the first catalyst will be the sale of the PAX business, that's JanSport and Eastpak, and or a sale of Supreme, rumored that Goldman Sachs has been shopping it for them. One morning, we will wake up to see that they've created $1 billion plus of asset sales, and the stock will jump when no one expects it. Then, by the grace of God and the hand of Bracken, sales from the remaining units will begin to accelerate when least expected. Finally, this is my guess, we'll see new hot brands added to the portfolio that no one can imagine right now to anchor the next phase of growth. How do we know this? Because they've been running the same playbook since 1899. Not 1999, 1899. This is a 125-year-old company, okay? So they've been through a few cycles, ladies and gentlemen. Same plays, different players. They always reinvent and recover to new levels. Could this time be different? Sure, it could always be different, but I wouldn't bet on it. As a matter of fact, I'm betting against it. And while they missed on the top and bottom lines last night and the market didn't like it, although it was down 10% after hours or 12%, and today it closed down 2 or 3% in a really weak tape. That's interesting. I like when stocks start to recover on really bad news and really bad environments. This is a short-term phenomenon. As I always say, the name of the game with turnarounds is free cash flow to give them enough runway to implement the turnaround plan. Here's what happened last night. First, they exceeded operating cash flow guidance for the fiscal year at $1 billion of operating cash flow delivered. They exceeded free cash flow guidance for the fiscal year at over $800 million of free cash flow delivered. APAC and EMEA regions grew in aggregate year on year. America needs work. Inventories are normalizing, and they took $80 million of costs out of the business. Here's the history. Not 1999, 1899. Look at these dudes with the hats. This thing has been around for a long time. It was established in Pennsylvania as the Reading Glove and Mitten Manufacturing Company. They do not sell gloves and mittens. Maybe North Face does. By John Barbie and a group of investors. 1920, they renamed the company Vanity Fair Silk Mills Inc. when it expanded into silk lingerie. Maybe they need to go in that direction. I don't know. 1940s, the company drops the word silk in its name due to an embargo on this material during World War II. Look, they've made it through a lot crazier things than a once-in-a-100-year event called COVID. Vanity Fair Mills goes public in 1951. By 1969, they entered the denim category. They had Lee brand, and they renamed themselves VF Corp in 1969. 1986, they acquired Bluebell, which included Wrangler, JanSport, Red Cap brands. Okay, so they used to have Wrangler. They used to have Lee. Maybe they'll buy them back. Who knows? But like I said, same playbook, different plays. These guys are masters of managing a portfolio of high-end brands. And then the 2000s, they got Eastpak, Nautica, Kipling, Reef, and they acquired North Face and Vans in the 2000s, their two biggest brands. So they didn't even exist 20 years ago for VF Corp. And everyone's up in arms. Then Splendid, Ella Moss, Timberland, Smartwool, Splendid, Williamson, Dickies in 2017. Nautica, divest from Reef. So this is what they do, ladies and gentlemen. So if you're losing sleep on whether North Face sales go up or down, or Timberland sales, or Supreme sales, or Van sales, they may not even be part of VF Corp in 2 years. They may find an opportunity to sell them, buy something better. They're going to figure it out. The key is they're going to sell something. They're going to pay down debt. Then they've got all the optionality in the world. The stock starts to move. They can raise equity if they have to, and they won't, but they can. And we're off to the races. So just again, zooming out, they bought Supreme in 2020 for $2 billion. They're probably going to sell it in 2024 for $1 billion. That's my opinion, not advice. But they'll do what they have to do, and just as they've been doing for the last 125 years. So Bracken at least says he, quote, feels energized that we're positioning VF to return to sustainable and profitable growth. From his lips to God's ears, the results were atrocious this quarter, certainly for the U.S. But as I said, EMEA and APAC in aggregate growing, which is more than just about half the business. And Americas, they're going to figure out. You look at Google search trends, they're starting to improve. The New School has already moved up to their second largest seller, which just came out when he became CEO. So good things are happening. They're still paying a dividend. I have no idea why, but they are 9 cents a share. And that'll probably go away, which will be a good thing, not a bad thing. And then, okay, so he starts off the conference call saying, almost everything is playing out as I expected it would when I took the role. We've taken the tough medicine we needed to return to growth. Key organizational changes, leadership changes, strategic moves largely have been executed by the time we get to the end of my first year, and I really feel good about them. So it's 3 parts. Reset, reignite, and accelerate. So reinvent, which we introduced back in Q2, is fundamentally how we get back to strong growth. Some perceive this as a simple restructuring plan or tactical steps. It wasn't, and it isn't. Reinvent is a blueprint for transforming a company from declining to growing. It has 3 key phases: reset, ignite, and accelerate. Reset is focused on the reset of the U.S. business Vans and the cost base and the balance sheet. Ignite is about everything, how we show up in front of our customer. Here, our focus is on product design, innovation, and merchandising, on commercial excellence and brand building. Our reset and ignite phases are occurring in parallel, and together we'll set the stage for the third phase, which will be accelerating growth. So they're done the reset. That's largely done. They've done the portfolio analysis and made the decision what they're keeping and what they're selling. And now they can move into accelerate. So they're in reset and ignite, and they're on the cusp of moving into accelerate. New CHRO came from Salesforce. That's good news. Another head of strategy was at Lululemon and BCG. New CFO from Spotify. I mean, they cleaned house. Reset phase, we're on track to deliver $300 million cost savings by the middle of the fiscal year. Progress on reducing debt, strengthening our balance sheet in the fourth quarter. So, all these things trade down for the same reason as debt. And any day the 10-year yield spikes up, these stocks trade down. And any year the odds of a cut goes up, these things rally. And it's going to be that way. But we've already laid out the framework of where things are headed in our view. And that's why we're positioned in the way that we're positioned. Okay, so free cash flow we covered, $800 million. Very early green shoots. Let's see here. In the fourth quarter, we delivered another significant reduction in inventories, bringing the total for the year down to 23%. Down 23%. This is huge, normalizing inventories. Down over $500 million, which in turn enables us to reduce our net debt by another $540 million. We also generated $1 billion in operating cash flow, more than our guide, $800 in free cash flow. They've established the Americas regional platform. If you remember, they were going to bring what's working so well in EMEA and APAC, which are growing, back to the US for more efficiency and predictability. They've done that. And while overall financial results have not yet improved, we are deep in execution and we are starting to see very early green shoots. You start to see the brand turn first in one channel or region, and it would spread to others. It started to happen already with direct-to-consumer Europe positive in the quarter for Vans. The inventory reset actions are helping to create a cleaner market in which to introduce new product. Our weeks of supply have come down with our partners in all three regions. We're simplifying our product lineup and introducing a sustained level of investment in design and innovation. New School, which I launched when I got here, is gaining strength behind enhanced marketing and has now become our second largest style globally. And that's in less than a year. Second largest style globally. That's huge. And the AV 2.0, our newest and best skate shoe, has performed very well in the early months of its launch. You can expect more news here soon, too. Cascade of product launches. He talks about how they slimmed down the marketing. They used to have 274 stories in one season. Now they've simplified it to a handful of powerful key stories. We're seeing Google search trends move in the right direction for the first time in years. The last 3 months have improved compared to the previous 12 months. Scaling, category expand. Okay, fine. Okay, I can tell you that you can expect that things will be a little bit better sequentially each quarter. We will return the company to long-term profitable and sustainable growth. So he ends with that. And then the CFO gets on. Guarini gets on. Let's see some key things here. All right, talks about the new platform, etc. While the underlying financial results from Q4 remain challenging, there was a slight sequential improvement relative to last quarter, and importantly, we've seen some encouraging developments stemming from the recent actions we've taken. Inventory declined by 23% ahead of expectations with the double-digit declines across each of the 4 largest brands. We're also seeing improvement in the level of health in our inventories with our wholesale partners. Reducing debt. Liquidity at the end of the year was approximately $2.65 billion. International businesses. Okay, run rate has improved in Europe relative to Q3. North Face direct-to-consumer was slightly positive. This is interesting. Lastly, the APAC region was up 2%, with all brands we distributed in the market growing except for Vans and Dickies, reflecting their ongoing turnarounds. Growth was led by continued strong momentum in the North Face and ongoing growth in Timberland. Importantly, as well, direct-to-consumer for the region was up high single digits, while Greater China remains strong, up 10%. Declines in Southeast Asia and Korea pulled down the performance of the region overall. So Greater China remains strong, up 10%. This is all confirmatory from what we saw with Goose and what we saw with Baba, and more of what we're going to see with Baba, Goose, and Vans. That should be a store. Baba, Goose, and Vans. Sounds like Scully and Scully or something. Baba, Goose, and Vans. All right, DTC was up 7%, reflecting the positive growth across all these regions. This is key as we continue to see outperformance in the APAC region, growing 15%, driven by Greater China growth above. This is North Face. As we continue to see outperformance driven by Greater China growth above almost 30%. So the North Face growth in China was almost above. How do you be above almost 30%? That must be a transcription error, but it's above 30% and partially offset by one impact returns on Australia and New Zealand. But up 30% for North Face in China is a big deal, and we saw it with the Goose. The Goose was loose in China. Sequential improvement. Supreme delivered another strong quarter. Sales up low double digits in Q4, which is good news if they're shopping it, so they can get a good price, get something with a B in front of it, pay down a bunch of debt, stock doubles. Everyone says, wait, maybe things are turning the corner. Then all of a sudden you get a sequential up in Vans, which no one expects. Stocks up to $30. People still skeptical. At 40 and 50, they start to get interested. At 80, they start to do cartwheels. And we say, let me help you out. Give you a few shares. Okay. 80 million in gross savings. Got that. Biggest brands. We expect to generate approximately 600 million in cash available from free cash flow plus the proceeds of non-core assets. Liquidity of at least 2 billion, which contemplates the payment of 1 billion. They're going to pay down 1 billion by December and 750 million by April, largely from asset sales and free cash flow. Now, Mike Bennett asks Bracken, you recently spoke to Vans Europe direct-to-consumer turning positive. Can you just help us maybe connect the dots in that market a little bit more? I know you like that as a leading indicator. You said that this is happening with inventory cleanup. DTC turned positive. Is it safe to say that inventories in the wholesale channel there had also been clean for that to happen in direct-to-consumer? Do you see some evidence that DTC could be a leading indicator on wholesale? So Bracken says, I do think that the turnaround started in one channel or one part of the world, and then they start to spread, but systematically. And I think that's what we're seeing now in Europe. We're going to see wholesale come pretty quickly there. DTC is already positive. And he does say, I do think this is a good leading indicator because we were never as overloaded in the channels in Europe as we were in the Americas, which meant the cleanup in Americas didn't need to happen in Europe in the same way. Okay. We'll end the year with more than 2 billion in liquidity, pay down of $1 billion, excess cash on the balance sheet, generate quite a bit of cash. Okay, this is key. So the analyst is asking, are you going to refinance the 750? And he's saying no. And then he's not saying we're selling stuff, but he's saying like, duh, the strategic portfolio review is now complete and obviously ongoing work there is associated with that. So I think you have the math right. The other thing on interest modestly lower, but not dramatically so. So he's basically saying, yeah, we're not going to refinance that. So if you're not going to refinance it, how the hell are you not going to default? The answer is his portfolio review is now complete, which means they've got some things that are going to be selling imminently. And we know Pax and Supreme are on the table. Maybe something else that we don't know. But the answer is there's going to be a B in front of it. All of a sudden, the debt's going to be paid down and everyone's going to say what happened. And it's a beautiful situation that Supreme is growing and they can sell it from a position of strength versus a position of weakness. All right. Now, the analyst asked Bracken, do you see that we're near a potential bottom at Vans? And he says, so I feel good about the steps we're taking. There's much more ahead we can do. Do I feel like we're at the bottom? I feel we're either at the bottom or super close. I really do believe we're going to, I could see the turn ahead through the tunnel. I'm not going to sit here. I can see it coming. I love the fact that DTC went positive in Europe this quarter. That's a great sign. Google search trends much better now than they were in the last 3 months versus the last 12 months. Again, things can wobble when you're looking at external data, but that feels good. So I think there's some real green shoots there. So he's basically saying we're either at or very near the bottom, and the market is a discounting mechanism. So I think all that needs to happen is like what we saw with Cooper Standard. Once they take BK or solvency risk off the table by announcing the sale of one of these assets that's on the block, and they pay down $1 billion of debt, everyone says, oh my God, they don't have solvency risk anymore. They're also generating, $600 to $800 million a year in free cash flow. So now it's off to the races. And then you start to see an inflection, and that's where you get multi-baggers. Look, they don't give away multi-baggers for free, ladies and gentlemen. If it was easy, everyone would do it. And thank God they don't, because that's why we don't have as much competition. So, all right. How do I say I feel? Okay, I have to say I feel so lucky, this is Bracken Darrell, that we're sitting here with such an incredibly rich assortment of brands, greatest optionality, portfolio review is complete, and so we're acting. We made a decision not to share what we're acting on or what we might be doing publicly, but you can believe completely that we're acting and we have optionality there. So he's basically saying, look, I got a handful of unbelievable brands. We decided which ones we want to sell. If our ask gets hit, we'll sell it. If it doesn't, we've got other options of what we can sell. The key is we've got a lot of outs. And if you know me long enough and you've been listening to my podcast long enough, I've been playing poker for 15 plus years with the same group of guys once a month, every month, and I like outs. And that's the name of the game. That's why we got into BABA. We had multiple outs. That's why we got into VF Corp. We got multiple outs with huge upside. And that's what we look for in turnarounds. Number one, solvency risk. Number two, free cash flow so they have the runway. And number three, lots of outs. And that's the name of the game for a multi-bagger when you're playing the turnaround Tom game. So we have multiple directions we can go. I can't give you the time frame when you'll see these actions come out, but we're going to announce them when they do. So it's not a question of if, ladies and gentlemen, it's a question of when, and it's a question of who gives them the best price for which assets. I do feel very good about where we are and very good about the review. AKA, we're selling stuff, we're going to get a lot of money, and all you guys selling in the hole are schmucks. That's basically what he's saying. If you can translate CEO speak into buy-side interpretation. Moving along. They can't be more clear. And these analysts keep asking the same damn question. It's kind of funny. By the way, the corporate headquarters for VF Corp is in Denver. Bracken is working in Costa Mesa out of the Vans headquarters, and he has been for the last 10 months. Tells you everything you need to know. U.S. Vans is the weakest drag on the whole business, and that's where he's spending, 100% of his time. And by the way, they're selling off all the corporate planes. This guy's deadly serious about a turnaround. And by the way, when the stock hits $80 or whatever it does, I can guarantee he'll be buying back the corporate plane just as we're getting out. So, all right. Okay, this is the key. And like the fact that no one's picking up on this and making this the headline of all the articles today is what creates the opportunity for people like us. Lorraine Hutchison says, great then. And then Bracken, I think you mentioned that you don't have any intention of refinancing the debt. By the way, this debt comes due in April of next year, the $750 million. Would that imply that brand sales would come ahead of the $750 million maturity? Like, give this lady the Nobel Prize for, genius. Like, how did she ever figure that out? Bracken Darrell's answer, one word, yes. Like, how many times did he have to say it in the same call? Basically, he's got a sale done, and the stock is pricing that they're going to let this thing run into default because they don't have any options. They got so many options. They got so much liquidity. They got so much free cash flow, and the market's just not going to believe it. It's the same thing the market's doing about the cuts. We all know we're going to get a cut or two this year. It's just the market doesn't believe it till it believes it. Then all of a sudden, you get the cut. Biotech goes up 30% in a few weeks. Emerging markets will be up 35% in a few weeks. Small caps will be up. Regional banks will be up. But until it happens, it's like that creates the opportunity to get the positioning you want to get. Couple words about Supreme. So then his closeout is, we've now got 5 consecutive months of predictability relative to where we were in the past. I mean, really, it's a big change. I also feel good about the steps taken across the business to really improve the overall performance. Okay, the top, predictability of reality. I'm super excited about the team here. I'm even more excited about the actions because they've already happened and they're ongoing. And it's great to see green shoots start to come through in some of these areas we've been talking about. I think those are a good indication of what's to come. So that's Bracken. Fear and Greed, middle of the range, 59. And we covered National Association of Active Investment Managers. REITs, top 30 weights. Earnings estimates in the last 60 days have been revised up for this year, 5.6%. Up for next year, 2.08%. Utility, same thing. Top 30 weights up 84 basis points the last 60 days. Up 77 basis points for next year in the last 60 days. PMI came in strong today. The market didn't like its strength. The jobs was a little bit better than expected. The odds of a cut went down. That's why you saw all this crazy turmoil, coupled with the stale Fed minutes from a handful of weeks ago. And the market just sold the news on NVIDIA. But yet, earnings estimates continue to climb higher, 244, 277, holding in there. And the podcast is over. Those of you who would like to stick around for the Ask Me Anything questions, please do. Everyone else, will see you next week, same time, same place. In the meantime, make it a great one. The disclaimer will come at the end of the Ask Me Anything questions. So, all right, I don't know. Let me see what this guy's name is. Vincent Sentmore asks, just catching up on last episode, I submitted a question about Lulu. Of course, someone asked about it last week too, LOL, but it does have a 2 handle on it now. So we just said that, we like Lulu. By the way, their chief product officer left this week. I'm not crazy about that. $299. I think this thing could go lower to $250 before I get interested. But it's a great business, great company, yada, yada, yada. I'm willing to miss this one, so it really needs to come down quite a bit before I get interested. But I'll probably set an alert at $250 and revisit it if it ever hits that. Julian Glock, curious about your take on Grab, the Uber of Southeast Asia. Super app there. All right, let's take a look. Grab. G-R-A-B. All right. G-R-A-B. All right, so they just turned cash flow positive. Their revenues are growing. I like what I see so far. Oh, that was on a last 12 months. Last 2 quarters were also negative free cash flow. So basically they had one good quarter. which was 2 quarters ago. Okay, let's take a look at the financials. Revenues are continuing to grow, but the growth rate is slowing. Balance sheet, probably pretty good balance sheet. $2 billion in cash. Let me shrink this down so we can get the whole thing in here. Long liabilities, long-term debt. Yeah, very clean balance sheet. Turning cash flow positive. Julian, I think this warrants more investigation. I think that you're probably onto something. I just want to understand the competitive moat better, listen to all the calls. What's the plan for growth? What's happening with market share? Are they in markets where Uber already is and they're eating their lunch, or is Uber coming for them and going to destroy them like they did to Lyft? But I like the starting point here, and I think it's definitely worth putting in more time. Yeah, and it has a long way to go, but definitely worth a look. You're on the right track, Julian, is what I'm saying. All right, moving along. Philippe Andrew Pinkos. I recall Warren Buffett sharing optimistic view on Canada's prospects. Understand you're long Canadian dollar. I'm not long the Canadian dollar. I think the Canadian dollar is going up relative to the US dollar. Besides Canada Goose, are there any other Canadian equities catching your interest for investment? No, I run a concentrated portfolio. I don't need more than one. I've got one China. I've got one Canada. I got one UK in GXO. Tiny little company, ASOS, which still hasn't shown me anything, which is why it's tiny. No, there are not other companies in Canada I'm interested in at the moment, but feel free to present one and I'll take a look at it. Johannes Jensen, interested in your thoughts about Diageo. Love the podcast. I think I covered this one a couple weeks ago. I mean, everything about it looks great, except you do have some GLP-1 actual risk because I still think I want to buy it here. So I would just say, I had dinner with one of the guy who runs all of sales for their biggest competitor, and he was telling me that he's buying it hand over fist for his retirement, like the competitor. So one of the things I love to ask people is when I meet them, it's not about their own company. I just say, if you had to put 100% of your net worth in one of your competitors, which would it be? And that I learned that one from Buffett. So I think you're going to be great with Diageo at these levels. Obviously, it took a hit in Latin America, but they'll work that out. Yeah, I like it. I'm not gonna go crazy about overanalyzing it here, Johannes. I think you're spot on. Opinion, not advice. Check with your financial advisor, etc. Andrew Dunlap, thoughts on Rimini Street? I don't even know what that is, but let's see if it comes up. RIMINI. All right, it got smashed. Revenues are going up. Recovering free cash flow. What do they do? Enterprise software products. All right, so again, this is technology software. You really have to understand what is their edge, who are their competitors, and why are they going to keep share? Is the share increasing or declining? How confident can we be that that continues? And this is the exact reason that Buffett has never owned these type of technology stocks, and he became the richest guy in the world. And by the way, everyone says, like, he's only worth $97 billion. He did that on purpose. He's given away over $100 billion, ladies and gentlemen. So he's still the richest guy in the world, just no one knows it, and that's the way he wants it. So you can get rich without buying NVIDIA. And he did so in buying very boring, predictable companies. Why? Because rule number one is don't lose. Rule number two, don't forget rule number one. And when you own companies that you can understand that have predictable moats, you don't have to worry about short-term price fluctuations because you're not going to sell in the hole because you know what you own and you can read a balance sheet, income statement, and cash flow statement, or at least take the time to do so, which seems fewer and fewer people do nowadays. But the ones who do have less and less competition and greater opportunity. So, yeah, I mean, I think you definitely gotta take a look at it. But this is going to be more of a qualitative decision versus a quantitative. Quantitative, it looks okay. Qualitative, I have no idea. So start the process. Start reading the last 4 annual reports. Start reading all the sell-side research. Establish and write down the bear thesis on the stock, and then write the bull thesis after you've looked at all the weak points. I think you might have something here, but you really have to do careful analysis on how do they maintain their moat, because the barriers to entry for software are not that high. So there's always a risk of here today, gone tomorrow. Pavel Rosenberg, which is very hard when you're Boeing and there's only one other company in the world that makes jets. So, or Disney that has the kind of parks, and to replace them would be at or near impossible. And the historic library and defensible things. GXO, second largest logistics provider in the world. Very hard to replicate. Thousands of warehouses and infrastructure and systems, etc. Pavel Rosenberg, have you taken a look at the Swedish company called Evolution Gaming, EVO? No. I've heard about it. I think it's one of these quality companies that everyone's talking about after it's up a ton, but let me take a look. EVO. Okay, so it ran up to 26 and collapsed, so broken momentum stock, going to take a while to repair. EVO. Yeah, I would say send that one back in a year. Wait, what's it called? Evolution Gaming. Okay. EVO. Okay, revenues keep growing, cash flow keeps growing. So what's the problem here? Why is everyone nervous? And by the way, when you send in questions, you should try to figure that out. People are nervous because X. I'm looking at it because that's not true, or I think it's different. But I mean, quantitatively, this thing looks okay. Let's look at the balance sheet. Fine. Great. Cash flow. Amazing. Yeah, what's not to love here? So why has it collapsed? And that's what you need to figure out. Why did people love it at 26 and they hate it at 4? And if you can answer that question, well, a new competitor came in and everyone thought they were going to take share, but they're actually going out of business. So we think that Evo is going to pick up share or something like that. So you're just going to have to go through all the sell side research, all of the earnings calls and public filings for the last few years, understand the turnaround, understand management's expectation. But you got to understand, why is the stock down 80, 90% before you buy it? And then if you can say, okay, I understand why it's down, I don't think it's as bad as the price is reflecting, then you could have a home run. So I think you might have something here. And what I can tell you is it's worth doing more work on for yourself, Pavel Rosenberg. So thanks for sending that in. And good work. Donald Williams, thanks for all you do. Was wondering if you could explain to me, like I'm a 5-year-old, about T+1 starting next Tuesday. Do you think T+1 will have negative impacts going forward? No, it de-risks. The closer you settle things, the less the chance of default, risk, fail to return on shorts, etc. It's a good thing, not a bad thing. Kai Low, hi. CPS debt a problem if the Fed doesn't cut rates? Market seems to be reflecting this in the stock price recently. We covered that. Number one, the answer is no, because they refinanced at the exact worst possible time. Number two, they have liquidity till 2027. Number three, they have options of things that they can do besides that. Number four, the Fed will cut. Number five, I think volumes are going to come in much better than expected. But what you will see on a day-to-day basis is when the 10-year yield goes up because of some stale Fed minutes or some idiotic Fed speaker coming out responding to the way the wind is blowing today, all the companies that have debt on their balance sheet will trade down. And then when yields compress, they'll all trade up. And the same will be true with Cooper Standard. This is another overreaction. I'm not concerned. Look, nothing in life is riskless. Otherwise, we'd have 150% in one company. The reason we own, albeit a concentrated book of 8 to 12 companies, is because there's always things that you don't know. But everything is probability weighted guesses. And the only reason people ever really get into trouble is they get too overzealous on one idea and too excited and they put too much weighting. Again, we have two mental filters. These are our primary and secondary filter. Number one is, if this company were to go to zero tomorrow, would they take me out on a stretcher? And the answer always must be no. And that's the number one thing, is to live another day. And if one company goes to zero because of something that I don't know or I can't know, can the other 7 to 11 companies more than offset to not only make up for that loss, but still outperform the indices net of fees over time? And if the answer is yes, of course I'm going to take it. Because probabilistically, nothing's ever 100% in life. But I like the odds, and then I especially like the odds over a basket of asymmetric investments with multi units of upside relative to 1 unit of downside per investment, per bet, if you think about it in terms of probabilistic bets and all of that stuff. So that's that. Quinton C. Thoughts on Brown-Forman? They're a leader of the industry, solid revenue growth, good free cash flow, stock's down 50% a few years. I keep looking at this one. I keep passing. I think it's the same story as Diageo, but better quality. I think if you buy it here and you take a long-term view, you're going to be okay. The only thing is, could it go down to 40 or 35 before it goes back up to 80? It sure could, but I like it. I've kept looking at it. I've done nothing with it yet, but I don't think you're wrong. So, Charlie L. At the end of the day, no matter how skinny people get, they still want to escape. And that's what alcohol does, is for people who like to escape, that's the way they do it. And, I just try to think, set more goals, and then you don't have to escape. You'll be more excited about overcoming problems, but, people are going to do what they're going to do, and they're always going to do it, and they've been doing it for hundreds of years. So I would bet on the perpetuation of people's interest in escaping from time to time. There's nothing wrong with it. And you can profit from it versus be at the effect of it. I'd rather profit from it than be at the effect of it, but to each his own. The short answer is I like your thinking, Charlie L. Moving along. Robert Y. What do you think about Burberry, 168-year-old British premier luxury fashion brand? They're refocusing their brand on Britishness. Okay, well, let's see. I invest in U.S. China. All right, Robert, let's take a look. I know we looked at this one a little while back. I think the reason I ignored it is because their revenues were going nowhere and the stock hadn't come down enough to... all right, so the stock's down 50%. Let's see what the financials down 50%. I guarantee you they're not. BUR. And people always wonder, why don't you do privates? Because no one's going to give me a 50% discount on a private if the financials aren't down 50%. And it happens every single day in the public markets. And there's no greater place in the world. It's just the most, it's literally, I skip to work every day. It's a treasure hunt every single day. Some people go to the beach and they use that machine to find wedding rings and soda cans to recycle. I go to the public markets, and a lot less work and a lot more rewards. All right. Burberry. Yeah, I mean, all right, let's look here. All right, so the issue you have is revenues really haven't grown in why is this taking so long? I've only got 5 Gs up and down. This thing should be humming. Let's go. I got so much gigabits coming into this computer, I had to get an adapter because the computer could only accept a gig in up and down. I now got 5 gigs up and down, so this thing better hum. All right, so revenues have been a little soft, basically done nothing in 10 years. That's not good. So how are they going to reignite growth? And I think you made a point. They're going to reinvest in Britishness. I don't even know what that means, but so far it's not working. And let's see here. Must be Koifin because it's not the internet. All right. Solid return on equity. Here we go. Cash flow is fine. $500 million a year. Not great. It's kind of come down in half. That's not ideal. That's not the right direction, but the stock has come down in half. Revenues are holding in. I mean, it's a sleeper. I think, look, if nothing else, Robert, I think you got to trade for 50 to 100% over the next couple of years. Dig a little longer, dig a little more. Just make sure that this isn't going to continue to deteriorate, because it's not like you're buying it down 80 or 90% where it's priced in a lot of continued deterioration. If this continues to deteriorate, it could go down another 30%. That's why I like to buy things that have already priced in a lot more bad things happening when we're at or near the inflection. And I've already got it down as far as that. But I think you're right, Robert. I think you're probably fine. But just understand share, understand what they're doing to revive growth. New jockey never hurts. Did you mention anything about a new jockey? A new proven jockey? Current CEO joined in 2022 from Versace. That's exactly what you need, is an Italian to bring more Britishness. But nonetheless, good luck with it. I think you'll be fine, and I like it. So let me write that one down. Burberry. Elise Jr., thoughts on FF? I don't know what FF is. Let's take a look. I think someone asked about that before. FutureFuel. Okay. Believe it or not, well, I'm not even going to go there with the politics, but all right, FutureFuel, what do they do? This thing looks like an EKG. It's up and down and up and down and up and down. This does not look like a high quality business. My guess is it's some manana promise of the future. What do they do? Diversify. Biophase fuel. I have no interest in this. I'll let someone else guess the future. I don't know if biofuels are going to be the future, or hydrogen, or whatever, or plain old hydrocarbons, at least for the next 10 years. Sam R. So I'm just a pass on this. I mean, I don't like the volatility of the financials. I don't like the fact that I got to guess what's going to be the preferred fuel source. It's not really growing. There's nothing here that makes me want to take a risk. Like there's higher and better uses. I mean, maybe you're coming at it from it's like a $5 stock. That means nothing. You'll probably be okay. I just don't know that you're going to make a lot of money on it. It's really where I come in without digging more. Maybe they have some amazing technology that no one else has, but it's not for me. Sam R, correct me if I'm wrong, but it appears that most of your stock picks like Baba, CPS, 3M are bought when the price is low versus historical. You think? Do you ever buy when the price on the chart is high? No. I'm old fashioned. I buy low and sell high. That's what I've continued to do. It takes discipline. Can you buy high and hope that to sell higher? Sure, you can do that. But you can also gamble on a roulette wheel and hope it hits, 28. Not what I like to do. I like to bet on sure things and play the time arbitrage game with low to no leverage, so I don't get stopped out. And just wait for it to realize its full value over time. I'll never change. I buy low and sell high, and I'm proud of it. So that's that. Baba Bear writes, the main overhang for Baba is Taiwan issue. China keeps edging and doing stupid drills. The world economy will literally collapse if Taiwan becomes China. TSMC will self-destruct their factories, and no one will be able to buy cars, etc., as everything has chips. Look, if China invades Taiwan, you have nothing to worry about because everything you own will be down in value. First and foremost will be the S&P 500 and Apple and et cetera, et cetera, et cetera. And then you got risk of World War III. So, if you want to make that bet, then you could make that bet, years ago, and you would have missed huge gains, and you'll make it for the next 5 years. So you can always bet on the outlier event and underperform for 15 years, and then you get lucky once every 10 years if you're still in business. Most of them are not. But go ahead and be a macro fund, and good luck with that. So I don't even know if there was a question there or if it's just a statement, but this sounds like a guy who saw Baba go from 68 to 90. He bought the top tick at 90. Now it's 80. He sends this in, and when it's back at 100 in a week or a month or whatever it's going to be, he'll be buying back up at 100, and he'll have a different name called Baba Bull, and he'll be like, why isn't Baba $160 yet, and yada, yada, yada. Ronan Bitten from Israel, thanks for writing in, Ronan. I'm very happy to have you. Before the question, thank you for all the knowledge you shared. Well, thank you for listening. Opinion on AXL stock. Let's give it a whirl. From Israel. That is awesome. All right. AXL stock. American Axle and Manufacturing. Okay. All right. Auto parts play. This one I've looked at in the past. I don't love it as much, but I think you're going to be good with that. Let's just take a look. All right, kind of sleepy business. Revenues are recovering. Margins are still contracting a little bit. Let's take a look at the financials. My guess is they have a debt issue. Revenues have been kind of flat and choppy. Take a look at cash flow. All right, they got decent free cash flow. It's down a bit, but it's okay. Return on capital. Let's take a look at the balance sheet. That's probably the issue. 500 million of cash and Debt is 2.8 billion. Yeah, so this is trading down because of the refinancing risk. Like all these type of companies are going to be good. I think you just have to get better understanding on the solvency. The free cash flow looks all right. When do all these debt maturities? Have they gone through the refinancing like Cooper Standard? Is it imminent? And on that basis, if you can get comfort with the solvency, I think you're okay. But why do you want to take that level of risk for maybe a double? I mean, it looks like the business has just been declining over time. I'm willing to take that risk for a super multi-bagger like Cooper Standard in my view. But this one's just been a sleepy business. It never really had a huge run or could revert back to that. So for me, it's a pass. I think as a trade, it works as long as you can get comfort around when the different aspects are refinancing. Jason Greenblatt asks, I've been hearing a lot about Peloton turnaround play. After recent financing news, I wanted to know whether or not you see this as a legitimate turnaround or just a maneuver to generate longer runway for potential take private buyout. I think this is not going to be a standalone company. I do think it's going to be a takeout. Cash flow positive for the first time while still spending an absurd amount of money on marketing. Would love to hear your thoughts, potentially touch on why turnaround play like VF Corp makes more sense than Peloton fundamental. Because VF Corp has multiple outs. We've got multiple high quality brands established around the world. Peloton is a all or nothing play, and the history of publicly traded exercise machines that become coat hangers is littered for decades, from Nautilus to Life Fitness to all of them. They all wind up in the same boat, and that's the same boat that everyone winds up with new exercise machines as they become coat hangers. So Peloton, the people who have been using it since COVID still love it, a lot of people, and continue to use it. But I think they're already like, if you didn't buy a Peloton during COVID, you're not going to buy a new Peloton now. That said, I'm willing to take a quick look at the financials for you. But for me, this is probably a $2 stock that gets taken out for, maybe 5 or 7 if you're lucky. And if you're not lucky, it just grinds into oblivion. Quarter. Barely free cash flow positive. So that's good. Revenues are continue to decline. Margins are accelerating. That's okay. Let's just take a look here at income. Yeah, so you're going from 4 billion to 2.6. The question is, where's the floor? The revenues continue to decline, and they've only got one product, so they don't have optionality. It's not like they can sell their treadmill business versus their bike business or anything like that. I think this is a trade. I don't think it's an investment. I don't see any real. Let's see what the balance sheet looks like. Yeah, they still got it. I don't think they're going out of business anytime soon, but if you get taken out at $10, it's a win. I just think there are higher, better uses of capital than that binary outcome, Jason, because the organic business itself, turning that around is going to be a very heavy lift. Garrett Kierzau. Thoughts on BYON turnaround? Big fan of the pod. Thanks for all your help. So this is the last question. BYON. Don't know what that is. Beyond what? Is this beyond meat? Beyond Inc. Oh no, online retailer of furniture, home furnishers. Okay. Yeah, this is like Leggett and Platt. A lot of these have been smashed because housing slowed down while rates have gone up. I do think this is going to be a good trend for the next 5 years once we start to get a cut or two. But this has never been a good business. I mean, this thing has just gone back and forth for years. So it sounds like the management is running it for themselves versus for the equity owners. Otherwise, this would be going from the lower left to the top right. Let me just see. And I don't see that changing if that's their, unless the new person came from a background of generating value for owners. All right, so their revenues have declined over the last 10 years. This is a declining business. So even in good cycles, they weren't even making money in 2018. What about cash flow? Negative. Yeah, this is a pass for me. I think the cycle is going to turn and Beyond is not going to benefit. I think like a Leggett and Platt would probably benefit because they're a better business. You know, these guys are getting smoked. This is probably a balance sheet issue, but I wouldn't really. For me, it's a pass. Maybe there's something I'm missing in the 2 minutes I looked at it, but thanks for sending it in. And with that said, we'll see you back next week, same time, same place. In the meantime, make it a great one. Bye for now.